What if I told you that one funding decision could determine whether your startup scales to billions of dollars or crashes before takeoff? Venture capital financing isn't just about getting money, it's about securing the right investors, the right deal, and having the right strategy for growth. But is VC funding the best choice for your startup? Let's break it all down. Hey everyone, I'm Corey, a startup lawyer helping entrepreneurs decode law, technology, and innovation. Today we're diving into how venture capital works, who the key players are, and what founders need to know before raising venture capital money. If you're a founder, investor, or thinking about scaling up a startup, this video is a must-watch for you. We'll discuss the trade-offs of VC funding because not every business is ready for it. So here's what we'll cover. What is venture capital? How venture capital differs from other funding sources, why venture capital can be a game changer, the venture capital ecosystem at a high level, who's involved, how the VC funding process works, and finally we'll close out with the risks and trade-offs of raising venture capital. So let's dig in. Okay, first, what is venture capital? Venture capital, or VC, is private equity funding for early stage, high growth startups. Investors provide funding in exchange for equity or an ownership stake in a business. Those investors are betting that the company will grow and provide big returns through an IPO or future acquisition. Unlike bank loans, venture capital doesn't require repayment, but founders must give up equity, which means sharing control of the company. A quick note on convertible debt. Many startups raise funds using convertible debt when they do not want to raise a priced equity round immediately. And this allows them to secure funding while delaying valuation discussions until a future funding round. We'll cover convertible debt in an upcoming video, so make sure you're subscribed. Okay, next, how VC differs from other funding sources. When raising money for your business, venture capital isn't the only option. So let's compare VC to other funding sources. So first, we have bank loans. It's a traditional bank financing where you borrow money and you repay it with interest. So the pros, there's no loss of equity. Full ownership remains with the founder. Cons, this requires a strong credit history. It often was going to require collateral and fixed repayments, making it difficult for startups with no revenue. So when would you use a bank loan? If your business has consistent cash flow and assets to secure a loan, but you don't want to give up ownership of the business. So next we have angel investors. They're individual investors who use personal funds to back early stage startups, usually in exchange for equity. So the pros, they're more flexible in terms generally than venture capital, and there's no requirement for immediate profitability given that they're usually coming in at the very, very early stages. So the cons, limited funding compared to a traditional venture capital firm, and the terms can vary significantly. So when to use it? If you need seed capital to build a product, to test the market, or to reach revenue milestones before actually seeking formal venture capital investment, angel investing is the area for you. So next we've got private equity and growth equity. So what is that exactly? You often hear these terms, private equity and venture capital, interspersed. Private equity refers to investments in mature companies with established revenue and profitability. So the pros, they can generally be large funding amounts, often paired with strategic expertise. The cons, private equity firms or PE firms usually take controlling stakes, meaning founders lose a majority ownership. Additionally, private equity firms tend to not play in the same space as venture capital firms, meaning that private equity firms tend to prefer mature businesses, whereas venture capital firms tend to focus on early stage, high growth startups. So when would you use private equity? If your company has consistent revenue and wants a liquidity event and you're comfortable with investors having major control over your future decisions. Next, we have crowdfunding. This is raising money through online portals where multiple investors contribute small amounts. The pros, there's no loss of equity if it's reward-based, and it's great for early stage validation, especially for products, things you see on sites like Kickstarter. The cons, it depends on strong marketing, and equity crowdfunding still requires giving up some ownership. When to use it? If you have a consumer-focused product and you can generate hype and early adopters. Okay, so what are the key takeaways? If your goal is rapid scaling, VC is the best fit. If you want to retain control, alternative funding sources like angel investors, private equity, or bank loans may be better for your business. To recap, venture capital is equity-based funding for high-growth startups. It provides more than just capital in the form of mentorship, networking, and credibility. Venture capital differs from bank loans, angel investor investment, and private equity in the risk, structure, and expectations of each of those types of investors. Founders must weigh the trade-offs before taking VC money. For startups ready to scale, venture capital can be transformational, but it's not the only path. And remember, we'll be covering convertible debt and safe cliff notes in an upcoming video, so stay tuned. Join me on the path to decoding law, technology, and innovation to grow your business. Don't forget to like, share, subscribe, and hit that notification bell. Until next time.